us to the measuring implications for rectangles. Technical analysis is best at identifying trend changes at an early stage, and not so useful in forecasting how far that trend will extend. Price pattern interpretation is one exception, since the construction of these formations offers some limited forecasting possibilities. Pretty well all price patterns obtain measuring objectives from their depth, and the rectangle is no exception. This diagram shows a rectangle which has formed and completed a top. The measuring implication of this formation is the vertical distance between its outer boundaries projected in the direction of the breakout, which in this case is a downward one. Later on, the price reaches twice the objective and bounces and finally reaches 3 times the objective. Note how the subsequent rally is halted at the level of the initial objective. In effect, the various multiples of the objective itself become important support and resistance areas in their own right. Unfortunately, there's no way to determine where the actual juncture point will be for any rally or reaction. This emphasizes the principle that in technical analysis there is no known way of consistently determining the duration of a price movement. It's only possible to speculate on the probability that a specific area will prove to be a support or resistance zone. Consequently, while this measuring formula offers a rough guide, it's usually a minimum expectation. If a rectangle appears as a bottom reversal pattern, the measuring rules remain consistent in that the vertical distance is measured and then projected up at the breakout point. The exact same principles also apply to continuation rectangles. This example shows an upside breakout from a rectangle that forms during a bullish trend. Note in this case that the price does not immediately reach its upside objective, but does so after a small rally and reaction. This is why the objective is described by the term ultimate. Most people buy the breakout on the assumption that they're going to make more or less instant profits as the price moves straight up to the objective, but that's not necessarily the case. A great deal of the time when the price breaks out from a pattern, the initial thrust is followed by a corrective move back to the upper or lower reaches of the formation, depending on the direction of the breakout. This is known as a retracement move, and it offers an additional entry point, often under substantially less emotional conditions. As a result, buying or selling can be undertaken in a much more controlled environment. This chart shows a breakout from a rectangle. As we progress, you can see that a retracement move is developing to the extent that it's possible to construct a small retracement trend line. When the line is violated, this confirms that the breakout is valid and that prices are ready to renew their advance. The retracement serves 2 functions. First, it helps to correct the excessive emotion associated with the breakout and brings people back to earth. From here, it's then possible for the new trend to extend on a more sound basis. And second, it acts as a test of the breakout. A downside retracement will find support at the breakout point and an upside one, resistance in the lower boundary of the pattern, as these 2 zones reverse their former roles. Retracements then represent normal price behavior, and although they can be frustrating, they are nothing to get concerned about. Indeed, the breakout itself is often a volatile, illiquid, emotional affair, as one side or the other heads for the entrance or the exit, depending on the direction. As a result, orders are often executed with horrendous fills. Price activity during the retracement process, on the other hand, is relatively quieter. If the minimal objective proves to be the ultimate extension of the new trend, a substantial amount of accumulation or distribution, whichever is appropriate, will typically have to occur before prices can move in their previous direction. In this case, a bullish rectangle has been completed and a breakout has taken place. The price also reaches its objective. Even though the price does not rise any further, it's still technically necessary for a trading range of the same size as the previous accumulation to be formed before a valid downside breakout can take place. I emphasize the word technically because this is not always the case, and there are lots of examples where large distribution formations have been cancelled by small ones and vice versa. That means if you can spot a cancellation, pay attention to the signal and look around at the other indicators to see if they agree. If so, go with the cancellation, as it's probably telling you the truth. In this chart we see a rectangle for the Swiss franc with its measuring objective. When we see the breakout, it's possible to identify another rectangle. Note that the lower part is at the objective level. Also, the second objective almost reaches the upper area. Many people see the breakout of the first pattern and expect the price to continue to move on up, but the formation of the second rectangle cancels out the first one, and anyone not paying attention to this would have lost all their profit. So far we've just considered price in our analysis, but volume, one of our basic building blocks, is an important independent variable that can help us obtain a more accurate reflection of crowd psychology. To quickly recap, volume typically goes with the trend. In other words, it expands with a rising trend of prices and falls with a declining one. This is a normal relationship, and anything that diverges from it should be considered a warning sign that the prevailing price trend may be in the process of reversing. Volume is also measured in relation to the recent past. Thus, heavy volume relates to volume 20 to 30 bars or so ago, not to volume, say, 10 years ago, where institutional changes may have permanently increased the level of activity. In the case of the rectangle, and with most other patterns, it's normal for the trend of volume to contract as the formation develops. Activity may continue to fluctuate along with the price, but with the benefit of hindsight, we would expect to see the various peaks and troughs of volume shrink as the pattern develops. Often when close to completion, disinterest prevails and volume often dries up. The quality of an accumulation formation is certainly improved if volume expands on the upside break, because that indicates that lots of buyers are motivated to push up the bid. My observation is that many breakouts take place with no noticeable pickup in activity. My view is that it's okay to go with such breakouts, but the more volume expands, the greater the probability that the breakout will not only be valid, but will lead to a worthwhile move. Sometimes you get reinforcement where it's possible to draw a trend line joining the lower volume peaks, and when this line is violated and the price breaks out, you have two bullish pieces of evidence. Thus, a good expansion of volume is a desirable condition, but not necessarily a mandatory one for a valid breakout. It certainly increases the odds, but other indicators such as oscillators could also tip the balance. At this moment, volume expands on the breakout, so everything's okay. However, if the level of activity falls like this, watch out on the downside. The shrinking activity is more than a missing piece of positive evidence, because it becomes an actual negative factor. Remember, it's an abnormal volume configuration for prices to go up and volume to go down. In this example, volume definitely declines as the price is breaking out. Such action typically signals that prices are advancing more on a lack of sellers than a strong, enthusiastic number of buyers. As the price starts to slip, volume picks up noticeably, suggesting that this is happening because of selling pressure. It's a definite sign that increases the possibility that the breakout's a whipsaw. Here we see a downside breakout from a rectangle. The same shrinking volume characteristics during the development of the pattern are present as for the bullish variety. However, volume characteristics on the breakout are less critical. This is because it's normal for it to contract as prices decline. Thus, contracting volume on a breakdown is perfectly normal, as we see here. What is not typical, though, is for it to expand on the downside like this. This in itself suggests that sellers are more motivated and therefore adds an additional negative flavor to the pattern. More often than not, prices will reverse and put on a small recovery or retracement rally following the downside breakout. This advance is invariably accompanied by declining volume, which itself reinforces the bearish implications. In this case, it's halted at the lower end of the rectangle, which now becomes an area of resistance. In terms of the weight of the evidence approach, it's better for volume to expand on the subsequent decline, just like this. The same idea of declining volume should accompany a retracement move, that follows an upside breakout. So far it's been assumed that any move out of the price pattern, however small, constitutes a valid signal of a trend reversal, or a resumption if the pattern is a consolidation type. Quite often, misleading moves known as whipsaws occur, so it's helpful to make an attempt at deciding when a whipsaw might develop. We've already seen that upside breakouts accompanied by noticeable declines in volume is one sign, but what about the price action? This chart shows a nice upside breakout. So good, so far as it goes, but later on we see the price fall back. The first sign that the breakout is a whipsaw develops when the price moves back into the body of the pattern, and the fact that the price is now zigzagging down is not encouraging. This is not what we expected, but when we progress, I can now see that the price has experienced another declining peak and trough at this point. So that's my second warning, and for me that's enough to liquidate. After all, if I bought on the breakout, the price is below the breakout level and is now experiencing declining peaks and troughs, what's the reason for still being in the position? Only hope, and the unwillingness to take a loss. Neither of these are good reasons. Sometimes it's possible to construct a small trend line joining some minor bottoms, so that its violation adds additional weight in favor of a whipsaw. Finally, when the price breaks below the lower boundary of the pattern, there's no doubt that it's failed. Another factor that can help early on in deciding if a breakout is valid lies in the fact that a legitimate one should hold for several periods. As an example, you may observe a decisive upside breakout from a rectangle on a daily chart, but if it cannot hold for more than one day above the breakout level, the signal is highly suspect. Often the technical position is worse after such breakouts. That's because those breakouts that cannot hold indicate exhaustion, and exhaustion moves are often followed by strong price trends in the opposite direction to that indicated by the false breakout. Here's an hourly chart for McDonald's. See what a nice breakout develops from this rectangle. Just when it seems as if we're going to make a nice, juicy profit, the breakout fails and immediately pushes the price back below the lower boundary of the formation. It goes back to the point that however strongly we may think that the price is going up, even if we rate it at a 99% probability, there is still that 1% probability that it won't work. That's why the first question you ask when entering a trade is, where do I get out if things go wrong? Where does the price need to go in order to invalidate the reason I got in? Assuming that, what is my risk relative to my conservatively expected return? In this case, the only place I can see is below this small trading range, because that would mean that the price had broken support in the area of the upper rectangle trend line, and the minor support below this trading range. Of course, the best place would be below the lower trend line, but that would be too much risk to take. Summary for rectangles. Price characteristics. A trading range bounded by two parallel trend lines. Volume characteristics. Volume shrinks as the pattern is formed. Better if it expands on the upside breakout. Immaterial on a downside breakout. Measuring implications. Depth of the pattern projected in the direction of the breakout from the breakout point. Signs of false breakouts. Shrinking volume on an upside breakout. Benchmarks for upside failure. Falls back into the pattern and violates a previous minor low. Violates an uptrend line joining previous minor lows. Crosses below the 50% halfway level of the pattern. Benchmarks for downside failure. Rallies back into the pattern and breaks above the previous minor high. Violates a downtrend line joining previous minor highs, or crosses below the 50% halfway level of the pattern. I mentioned earlier that reversals in trend are usually preceded by a trading range. Over the years, technicians have noted that they take many different forms, known as price patterns or price formations. The rectangle is just one of these. Since the interpretive principles of these patterns is pretty similar, I'm going to continue by using the rectangle as a kind of case study to outline those principles so that we don't have to duplicate them with the explanation of each of these formations.